Hi class. In this video we're going to go into chapter 3, which is a continuation of job order costing, but specifically this chapter looks at cost flows and external reporting. So we'll be able to see a little bit of what those journal entries look like and how they flow from one account to the next. So there are some things that we just need to make sure we remind ourselves of. Hopefully you've refreshed on some vocab from chapters 1 and 2 before getting into this chapter. One thing that I will do a little reminder of is the assigning of overhead, or how to apply overhead to jobs. Okay, so applying overhead to jobs, we're going to need to remember how to do that. Okay, so remember, in order to apply overhead to jobs, we multiply the POR by the amount of the allocation base that was incurred by a job. So amount of allocation base incurred by a job in particular. So if a specific job is using 5,000 machine hours, we multiply that 5,000 machine hours by whatever the POR is in dollars per machine hour to figure out how much overhead we are going to assign to that job. Okay, and remember that your POR is going to be defined as your total estimated manufacturing overhead divided by the total estimated number of the allocation base, or simply we call it activity. So the estimated level of activity. All right, so for this chapter, we are going to have to expand on the various inventory accounts. Because remember, in financial accounting, when we talked about inventory, we were referring to, either goods that we purchased for resale, or we were just assuming they were, units that were finished and ready to be sold to customers. But from a manufacturer's perspective, just to have an inventory account or say, oh, there's just one inventory account, that doesn't suffice. There's actually more than one inventory account if you are a manufacturer. And these three accounts are as follows: raw materials, work in process, and finished goods. So each one of these inventory accounts are considered assets, right, since it's inventory, which means you will see it on the balance sheet. Okay, raw materials, when you look at that account, it's the cost of any materials that go into a product. So if you look at the raw materials account, if it has a $10,000 balance, that means we have $10,000 of raw materials on hand, ready for us to use in the manufacturing of our products. So raw materials are untouched. They have yet to be put into production. So if you look at the balance of that account, it's the cost of the materials that we're going to be using on our final product. Work in process, which you'll often see abbreviated WIP, that consists of the cost of the units that are only partially complete and need further work done to them to be ready to be sold. So as soon as we use some raw materials and as soon as we use direct labor, those costs are moved into work in process. So if you look at the balance of the work in process account, it's at any given time, it's the cost of the units that are still being worked on. So basically the money that's been poured in so far into those units, but they're not quite done yet. And then finished goods, that is the cost of the completed units that just aren't sold yet. So if you look at the finished goods account, whatever balance that account has, that says, okay, that's the cost of all of my completed units thus far. And as soon as I sell some of those units, the cost of those units are going to move out of finished goods and into our cost of goods sold account. So there's a new term popping up in this chapter called cost of goods not sold but manufactured. And that will be shortened as COGM often. for our purposes. So this is just a term that refers to the manufacturing costs associated with goods finished during the period. So that number is going to refer to the cost of the goods finished for that period. And we'll be circling back to that a bit later on in our discussion here. So first we're going to look at these 3 inventory accounts and how they're affected through increases and decreases and costs flowing between them. So what happens if you purchase raw materials, right? Raw materials, they can be used in production as a direct or indirect material or both. So let's, for example, say that a company in question bought $60,000 in raw materials on account. So the question is, what would that look like? Okay, well, how would we go about journalizing that? So remember, our T account, this raw materials, it's an asset account, and it is increased with a debit and decreased with a credit since it is an asset account. So any material purchases, they're going to be debits to this account. But anytime you use raw materials, that'll be on the opposite side. So let's take a look at what this might look like. Okay, so they bought $60,000 in raw materials. That means raw materials is going up, so I'm going to have to debit my raw materials account for $60,000. And then since it's on account, I'm going to credit accounts payable for $60,000 as well. Now, if this was purchased in cash, then instead of crediting accounts payable, we would simply just credit cash in that situation there. Okay, so that's what it looks like when you purchase raw materials. But what about when I use them? What about use of raw materials? Well, when you use raw materials, the first thing you're going to have to do is fill out a materials requisition form. And there's an example of that in your book. And that just basically helps to keep track of inventory. And this is what I'm taking out of inventory and what I'm going to be using it for. So that's something that needs to be done on the managerial side. But let's assume that the company used $52,000 of raw materials. And let's assume that 50% of it is used for direct materials. And then 2,000 is considered indirect. Okay? So how in the world would we go about journalizing that? Okay, so remember, once you use raw materials, it's going to go out of the raw materials account and into the corresponding account that it needs to go to. Now, direct materials. When you use direct materials in production, if it's going from raw material form and actually into production, those direct materials that you're using are going to be moved out of raw materials into work in process. Okay? And we're actually saying, okay, this is how much I actually use. This is actual raw materials that I am using. So this is a definite amount here. And we for sure know that we use $2,000 in indirect materials. Well, indirect materials, remember, what category do they qualify as? Remember, it's manufacturing overhead is all your indirect costs. So the $50,000 of raw materials that is considered direct material, is going to be used for direct materials purposes, needs to be moved into work in process, where the $2,000 of it that's indirect materials is going to be moved into the manufacturing overhead account. Okay, before we journalize that, remember, because there's a difference between actual manufacturing overhead, once you know an exact number like here, right? We know that for a fact. Oh, sorry, the 2,000 here of the 52. There's a difference between actual overhead and applied overhead. Applied overhead is what we've learned to do in Chapter 2 before we know those actual figures, right? Using the POR and the application formula. But there's only one manufacturing overhead account, and we need to keep track of those actual numbers as they are available to us, but also to those applied numbers. So anytime you debit manufacturing overhead, that means you are referring to actual manufacturing overhead costs. But anytime you credit manufacturing overhead, that means you are applying overhead to a job. Okay, so a debit to the manufacturing overhead account refers to actual overhead. Anytime you credit it, that refers to applied overhead in that sense. So let's see how that works. We said of the $50,000 of direct materials needs to be moved into work in process. So we're going to put $50,000 in that account with a debit. And then we said the other $2,000 refers to actual manufacturing overhead costs. And then we're going to credit raw materials for the full $52,000 because you're using $52,000 of raw materials, so it has to move out of that account and into these two corresponding accounts, 50 of it being direct and 2 of it being indirect materials. And these aren't estimates, they actually know, okay, that's actually how much materials we used, and this is the amount of it that's direct and this amount of it's indirect. So this $2,000 indirect materials amount is a known figure. This isn't an estimate. That's why we debit manufacturing overhead to refer to an actual overhead amount in that situation. Next, what about if we're not talking about materials but labor, right? Recording labor cost. So let's see what that would look like. So let's say according to this company, they incurred $60,000 in direct labor costs, $15,000 in indirect labor costs, and this is all based on the time tickets. Okay, so if this is based on time tickets, are these actual figures or estimated figures? These are actual figures. Okay, so remember that work in process is an account that is made up of the direct materials, the direct labor, and the manufacturing overhead applied to a job. So all of those things are thrown into work in process. So the $60,000 of direct labor cost will need to be put into my work in process account. But the $15,000 indirect labor, remember indirect labor is considered to be part of manufacturing overhead, so that would need to go into the manufacturing overhead account. And again, these aren't estimates, they are actually based on real information. We actually know for a fact that we spent $75,000 on labor. So how do we record that? Remember, the direct labor needs to go into work in process. So we would debit our work in process account for $60,000. And just as a reminder, manufacturing overhead, the debit side is the actual side and the credit side is the applied side. So I'm going to debit work in process for $60,000, and then there's $15,000 of actual manufacturing overhead, so I want to debit that account, manufacturing overhead for $15,000. We're not in balance, right? So how would we go about doing that? We could just ask ourselves, how did we record salaries, expense, and financial accounting? We debited salaries, expense, and credited salaries or wages payable, right? So same thing, we're going to credit salaries / wages payable. And that is for $75,000. Okay, so that's how we record labor costs. Okay, now as the period goes on, we'll know what some of these actual overhead amounts are. We don't know what the actual overhead is going to be at the beginning of the period, right? But we might find out what these actual overhead costs are as we go. But we won't know what the total actual manufacturing overhead is until the end of the period. That's why as we work on jobs, we apply overhead to them until we actually know what the actual amount is at the end. And again, we'll see how to deal with that. Okay. Now, what about other general costs? Let's see. So let's assume the company incurred general costs in the factory for the month as follows. And I'm using the numbers from the PowerPoint so that hopefully these numbers would be a little bit familiar when you go to look back at that. So let's assume that this company incurred utilities, factory utilities of $21,000. Rent on the factory, let's assume that's $16,000. And then just other general manufacturing overhead costs, random ones, totaling $3,000. So in total, that looks like there's some general factory costs of $40,000 there. Again, these are factory costs, right? Utilities, rent, and other general manufacturing overhead, all of these aren't traceable very practically or easily to a particular cost object or if we're talking about a specific unit even or a job, right? So that's why utilities, rent, and other overhead, these types of costs are just considered part of overhead, okay? So these are general costs incurred, right? The key word here is incurred. So these are, we know for a fact that these are actual costs. You know what your utility bill is eventually, right? You should know what the rent on the factory is. And as the other random bills come in, right, might be smaller bills, you'll know what those are as well. So how would we record this general amount of manufacturing overhead of $40,000 here? That doesn't necessarily include indirect labor, indirect materials. So we've already done that part of overhead, right? The indirect materials and indirect labor, but these are other indirect costs. So again, as a reminder, if we want to record actual overhead, it's going to be a debit to that account, right? Not a credit, because if we credit it, that refers to applying overhead. So to record these actual overhead costs of $40,000, again, we'll debit manufacturing overhead. This time for $40,000, and then we'll credit accounts payable, or cash, but in this case we'll just use accounts payable, assuming we haven't paid all of it yet. Okay, so a debit to manufacturing overhead and a credit to accounts payable. So keep in mind that manufacturing overhead is going to be separate from your work in process account. Okay, so when it comes to work in process, that's where your direct materials and direct labor will go, and manufacturing overhead has a separate account. That's why we're journalizing this as follows. So what does it look like when we want to apply overhead to a job? Okay, so what would that journal entry look like? So let's assume that the POR we've calculated for this period is $6, okay, and we'll assume it's per direct labor hour. And job A used 15,000 direct labor hours. So let's just assume that. How much overhead would we apply to job A if that's how many hours, direct labor hours, the job incurred? Well, it's $6 per direct labor hour times 15,000 direct labor hours gives us $90,000 in overhead to apply. Again, this is an actual overhead, right? This is just our best estimate of overhead at this point in time in order to get an accurate reading for now of what the cost is of job A without just keeping an empty hole there for what manufacturing overhead might be. So although $90,000 isn't necessarily the actual amount, we'll find out what the actual amount is. This is going to be our best estimate for now. Okay, so how would we go ahead and journalize that $90,000? Well, we're going to debit work in process when we apply overhead. We're going to debit that for $90,000. And then we're going to credit manufacturing overhead for $90,000 as well. So it's this entry right here where the work in process account actually will receive overhead only when you apply your overhead. So It's your direct materials and direct labor, they immediately go into work in process, but it's not until you actually apply overhead, right, which is its own account, where it gets moved through the application process to work in process for the time being. So this is an example of an application of overhead. I debit work in process for the $90,000 and I credit manufacturing overhead for $90,000. So the manufacturing overhead account now, we're not working with actual overhead, we're working with applied overhead. So that's why we're crediting this manufacturing overhead account here. So putting that $90,000 in work in process and then crediting manufacturing overhead for that amount as well. So what about non-manufacturing costs though? Everything we've talked about so far is all manufacturing costs, direct material, direct labor, and overhead. Whether we were talking about actual overhead and the amounts that we know or applied overhead. Non-manufacturing costs, are they applied to a job or assigned or anything like that? They aren't, right? Because it's non-manufacturing costs. So non-manufacturing costs, they are not, okay, assigned to individual jobs. So you won't assign a non-manufacturing cost to a job. Instead, and this is very important to remember, they are expensed in the period that they are incurred. So examples of these kinds of things would be the marketing salaries of the marketing staff and selling or admin salaries as an example of those employees, and even advertising expenses. Those are costs that have nothing to do with the manufacturing process. So they are expensed in the period that we incur them as opposed to being assigned or applied to a job. So let's assume that the company incurred $30,000 of SAG costs, meaning, selling administrative in general, some mixture of those, right? Let's assume it's $30,000 of SAG costs. So I'm going to specifically assume that this is $30,000 of salaries. So we would journalize this how we remember from financial accounting, right? The prior costs that we talked about, direct materials, direct labor, manufacturing overhead, these right here are inventoriable costs, meaning that they sit in inventory, right, until they're sold. But selling administrative and general costs and even advertising costs, these aren't inventoriable, they're expensed right away. And that's what we're used to from accounting too, in financial accounting. We debit an expense and then credit either a payable or a cash account. So in this case, since we're talking about salaries, we would debit salary slash wages expense. We'll debit that for $30,000. And then we'll credit salaries slash wages payable for $30,000 as well. And again, if this were to be in cash, it was already paid in cash, we would use cash instead. But here we're crediting salaries payable. So that shouldn't be any different from before, from what we're used to in accounting too. Now what about if we're talking about depreciation, but not on factory equipment, but depreciation on office equipment? What would that look like? So this will be reminiscent of what we learned about depreciation and how to journalize for that in financial accounting. So let's assume that for this example, this company incurred depreciation on its office equipment of $7,000. Well, if this is not depreciation on factory equipment, it's not going to be considered part of manufacturing overhead. But instead, this will be an expense of the period because it's just depreciation on office equipment, nothing to do with the manufacturing side of things. So recall, when you record depreciation expense, you debit depreciation expense for $7,000, and then we credit that contra asset account called accumulated depreciation for $7,000. So that's what our depreciation entry would look like if it's just regular depreciation on regular office equipment. So that's a little bit of a review with regards to recording depreciation. But then what about advertising costs? Let's say we incurred advertising costs of $42,000 and other just regular SAG costs of $8,000. Well, advertising costs, remember, they're expensed in the period in which they are incurred, so we would have to record an expense for that one, and as well as these other SAG expenses if they aren't identified as salary or wages expense. So we would debit advertising expense for $42,000. Debit, we can just call it debit other SAG expense for $8,000, and then we will credit accounts payable for $50,000. So that is also just a little bit of a review of entries that we've known how to do and that we learned about in financial accounting, but we just want to make sure to differentiate that difference. So these aren't manufacturing costs, these are non-manufacturing costs, so they are journalized as follows. But previously, as we saw with the manufacturing costs, those are inventoried, meaning they're going into work in process and eventually going to be moved to finished goods when we finish doing the work on those. So, speaking of completing a job, let's assume we're looking at job A. Okay, let's assume job A was completed by the end of the month. Let's assume that it cost $150,000 to complete, and let's assume it consists of 1,000 units. So this $158,000, that $158,000, remember that's what it cost us to finish a job. That's your cost of goods manufactured, because that's the cost of manufacturing job. So at this moment in time, that $158,000 is sitting in work in process, but we've now spent the last dollar in the amount of $158,000 to get that job complete. So that $158,000 has to now move from being in process, work in process, to our finished goods account. So it needs to be moved over here. So I need to move that. How do I move that over? I have to credit the work in process account and debit finished goods to move that amount over. So that cost of goods manufactured for job A is moved into finished goods now because it's complete. So in journal entry form, we would debit finished goods for $158,000 and credit work in process for $158,000. So that's the movement of the cost of goods manufactured from work in process into finished goods. All right. So we said job A consists of 1,000 units. So we know the total cost to finish job A was $158,000. So what's the per unit cost? Right? We looked at that in chapter 2. You simply take that total cost and you divide it by the number of units. So that means that the per unit cost of every unit in job A is $158. So what happens if now we sold 750 units of job A? How would we go about journalizing that? Well, remember when you sell inventory, recalling from financial accounting, you record the sale, that's one entry. But you also have to record the cost of the sale. That's a two entry thing that needs to happen there. when a sale occurs. So to record the sale, you kind of need to know what it was sold for, right? So let's assume that those 750 units were sold for $225,000. That's an assumption there that we're making. We sold 750 units for $225,000. So let's assume that wasn't in cash, that was sold on account to our customers. So remember, when you can't receive cash right away, then we don't debit cash, but instead we debit accounts receivable. So to record the sale, we're going to debit accounts receivable for $225,000, and then we're going to credit sales, because remember, to increase the sales account, you credit that. But we can't just stop here and call it a day, because that's just entry 1. We also have to record the cost of that sale. So the cost of the sale, how do we do that? Remember, you have to debit the account called cost of goods sold. But how do we know how much to put into cost of goods sold? Well, we sold 750 units. What was the cost per unit? Remember, we found that to be $158 per unit. So 750 times 158, that's a total cost of $118,500. So we want to debit cost of goods sold for $118,500, and then we'll credit finished goods for $118,500 as well. And now, if you were to look at finished goods, the T account, finished goods then would only have the 250 units left, the cost of the 250 units left in that account, because we just sold 750 of them, of the total 1,000. Okay, so that was overall a little bit of a look at the different cost flows and how we journalize not only manufacturing costs, but non-manufacturing costs in a job order costing system.